few important theories as the meaning of partnership. Already you are aware about the meaning of partnership and all, but just for review purpose, so that we can have a thorough practical application, here we'll see the meaning of partnership. As you know, partnership is association of two or more persons. That is, when two or more individuals they come together, when they pool their resources called capital and managerial ability and form a business, that is called as a partnership business. And each individual, we call them as partner, and collectively we call it as a partnership firm, and the name under which the business is carried on is called firm name. And then comes the definition, like according to the Partnership Act of 1932, we have section 4, which defines partnership as relationship between two persons who have agreed to share the profits of the business carried on by all or anyone acting for all. Then this was the basic. But now it is very important to know what is the partnership deed. As you know, it is the relationship between two persons, and this relationship, it comes into existence as a matter of agreement. And that agreement, whatever the terms and conditions are agreed among the partners, that has to be put in black and white, that is in the form of document. And that document, what is formed for the running of the partnership firm, is called partnership deed. And here starts the important practical approach of the partnership deed. What does the partnership deed? It gives the specification to the partnership. It gives specification to the partners how the business is to be conducted and so on. And that partnership deed is nothing but it is a legal document, we call, which contains terms and conditions, or you can call rules and regulations. So dear students, examination point of view, 2 marks you can expect, either the meaning of partnership or definition or partnership deed. Generally, the partnership deed is the most expected question. Now comes the next important subject, like what are the provisions? This is the practical approach, and here we are seeing that when there is no partnership deed, I mean to say when the partnership deed is not maintained by the partnership firm, then what are the rules applicable? We know that last year in theory we studied there is no registration and so on. Like that, here sometimes the partners may not have the partnership deed. Orally they may agree to do the business. In that situation where there is no partnership deed, then what are the rules applicable? Here are the rules which are applicable in the absence of partnership deed. These are going to act as the guiding factor when you are supposed to do the solution. So focus on this mainly. What is the first rule they are telling? The first rule is that they are going to share profits and losses equally. They are going to share profit and losses equally. Say for example, if there are two partners, then they are going to share profits equally, means in 1:1 ratio. If they agree, that is secondary, but if there is no agreement, then they have to share profits equally. Then the most second important point is they are not going to get any interest on capital. In the sense, no partner is going to get any interest on capital. Third, when they are not getting interest on capital, similarly, interest on drawing will not be charged. In the sense, if partner withdraws money from the business, that is out of his share of capital what he introduced, then on that they are not going to charge any interest. And the most important part, what rule we apply is, sometimes besides giving the capital, the partner may give loan or advance. He may give loan or advance. That case, he is eligible to get interest at the rate of 6% per annum. Interest at the rate of 6% annum. That is, if any amount is given by the partner as loan or advance, then he can get 6% interest. For example, if they have agreed 8%, then they can pay 8%. If they have agreed 4%, they'll pay 4%. But there is no agreement at all, then he can get up to 6%. Then comes the next point where we see that no partner I'm telling will get any remuneration. That is salary, commission, any extra benefit is not going to get other than the profit. These are the 5 rules which are applicable when there is no partnership deed. But generally we see that there will be partnership deed and all these items are given. And based on these, I am going to teach you the problem. Now, having seen this, we'll see the next concept where we are going to focus on the practical session now. And that is all about maintaining capital accounts and preparing the profit and loss appropriation account. First, we are going to learn the meaning of profit and loss appropriation account. Dear students, please keep in mind profit and loss account is the nominal account which is prepared to find the net profit. Whereas in case of partnership, we give an extension to the profit and loss account, and that extension of profit and loss account which is given to find out the divisible profit, and that extension of profit and loss account is called profit and loss appropriation account. As I told you in the previous part that there are some things which are not applicable, like I told you interest is not paid, interest is not charged, interest on loans and advance is 6%. Like that, sometimes there are specifications where the partners agree to give remuneration, where the partners agree to charge interest on capital, interest on drawings and so on. In that case, we prepare appropriation account with an intention to find the net divisible profit. Please see on the word net divisible profit. Generally they say net profit. No, that is the profit which we are going to divide among the partners. So we should call it as net divisible profit. Now why the divisible profit? As I told you, partners, they come into agreement to conduct the business so that whatever profit they are going to earn, they will distribute among themselves. That is called divisible profit. It's not compulsory that always we'll get profit. There is chance of loss also. So either we may get profit or loss, but always we think positively and we use net divisible profit. Then, so the profit and loss appropriation account, what it is? As we said, it is nothing but it is the extension of profit and loss account. And that profit and loss account, what we do? In that extension, we give all the provisions which are involved with the partnership deed, like how to pay interest on drawings and so on, and we come across the profit which is called net divisible profit. Then comes how the partners they maintain capital account. There are 2 methods, that is there are 2 ways where the partners they maintain capital account. First one we call fixed capital method and second we call fluctuating capital method. This is also a likely expected question in theory. Fixed capital method, fluctuating capital method. So having the knowledge of maintaining the capitals is also important. So the first method is called fixed capital and second is called fluctuating capital. Now what we do in fixed capital method? Fixed capital method is a method of maintaining capital where each partner capital will remain fixed. It is not going to be changed. It is not going to change unless we introduce additional capital. That is, for example, let me say there is a partner with the name A, and if he has invested 1 lakh, in capital will show 1 lakh only. If he is going to invest additional capital 50,000, then it will become 1,50,000. Then what about his share of profit and also? That we are going to show in another account. Like that, in fixed capital method, we are going to maintain two accounts. One is capital account and other is current account. Under fixed method, we maintain capital account and current account. What we do in capital account then? In capital account, only and only the amount invested by the partner as the basic capital, or if he introduces any additional capital, that alone will be shown in capital account. And the most important point here, which generally no one will consider, is about cap drawings. Sometimes when the partner withdraws the capital drawings, when the partners makes the drawings, and that drawings must be out of capital. Please keep in mind, it must be made of capital. That you have to focus whether they say the withdrawals are made of capital or they are made out of profit. If they use the word capital, then it is given, that is, we are going to debit to capital account and thereby the capital will reduce. Then what is the significance of current account? Significance or the purpose of maintaining the current account is to record all other transactions other than the capital. What are the other transactions relating to the partner? As we said, like there may be drawings, there may be share of profit, there may be interest on capital, there may be remuneration, like that. All these transactions we are going to record in current account. We are going to record in current account. And thereby what will happen? Year after year, the capital amount, that is the current account balance, will start fluctuating. In the sense, it will start varying. It will start to increase or decrease. And that is called fixed method of capital. So what is fixed method of capital? It is a method of maintaining the capital where the amount of capital remains unaltered. Unaltered we can say, or fixed we can say. And in this we maintain two accounts. One is called capital account and one is called current account. Under capital account, amount of capital remains same, and if we make any drawings out of capital, then we are going to debit it to capital account. Whereas in current account, all the transactions like interest on drawings made out of profit, salary, all are accounted, and thereby the capital will fluctuate. Then comes the next method, which is called your fluctuating capital method. Now what we are going to do in fluctuating capital method? Under fluctuating capital method, we are going to prepare only one account, and that is capital. The name itself is fluctuating. Fluctuating means one which changes. One which changes, and that changes is due to either increase or decrease. So how this is affected? They say that when one account called capital account is maintained, and in that along with the transactions called capital introduced, when all other transactions are recorded, then we call it as fluctuating method of capital. And practically we follow generally fluctuating capital method while maintaining the partner's capital account. Generally, I'm telling you, we follow fluctuating capital method. Like that, we have two methods of capital. One is fixed method and one is fluctuating method. Under fluctuating method, we maintain one capital account, and in this we record the transactions like capital introduced, capital withdrawn, interest on capital, interest on drawing, shares of profit, remuneration, everything we are going to record in capital account. Whereas in fixed method, we record those transactions in current account. Like that, here we have two methods of capital. Now based on this particular subject like profit and loss appropriation and maintaining the capital accounts, we are going to solve one simple problem. And this particular postings, whatever I'm going to teach you, they are going to be the base for doing the problems called admission, retirement, and so on. So here comes the question for you. Like if you focus on the question, you can see what they give. They say that A and B are partners. There are two partners who are sharing profit and losses in the ratio of 2:1. Okay. They have agreed to share in 2:1. If this particular ratio was not given like 2:1, then we were telling or we were taking it as 1:1. Like that, since they have agreed 2:1, we are going to take as 2:1. And they have contributed rupees 1 lakh and 60,000 respectively towards their capital. What does it mean? It means A invested 1 lakh, B invested 60,000. This is amount of capital. The partnership agreement, in the sense the partnership deed, provides the following. And what they have agreed? They said interest is allowed at the rate of 8% per annum. They are agreed. So they have to pay interest to whom? Partners. Then Mr. A is allowed a salary of rupees 20,000 per annum. Salary, in the sense remuneration. Who is getting remuneration? Only the partner called A. Like that, during the year, A takes 10,000 and B takes 5,000 towards which use? Personal use. Personal use means drawings. Then interest on drawings rupees 1,000 for A and 500 for B. Then if we look at bit number E, what they said? They said the partners decided to transfer 8,000 to general reserve. So please follow the technique how the problem is to be done. So how the solution it goes. So to start the solution, we are going to write first the heading as it is in the books of Messrs A and B. Since it is a firm called A and B, we wrote firm name. Then we'll write profit and loss appropriation account for year ending, and the year ending is 31st March 2020. So we are going to draft profit and loss appropriation account. Maybe about 7-8 lines we need. So here we'll draw profit and loss appropriation account, and it's always advisable to keep an inner column so that your postings they become easy. Having drafted the profit and loss appropriation account, below this you can draft your partner's capital account. Since there is no place, I'm doing it in the next slide, and that is we are preparing partner's capital account. Now here when we do partner's capital account, either you can maintain individual capital account or you can maintain in one account the columns for different partners. Generally we maintain columns like this. If there are two partners, we maintain two columns. If there are three partners, three columns, like that. So here partner A, partner B, partner A, partner B, credit, debit, credit. As it is, particulars, amount, particulars, amount, we wrote. Now partners capital 4 to 5 lines will be enough. Below this we are going to do all the working notes. Now how the postings are to be started. First they said Mr. A and B are partners sharing profit and losses in which ratio? 2:1. This is very important. So we'll come and write working number 1, profit ratio A is to B. What is the profit ratio? 2:1. So here understanding 2:1 is important. 2:1. So 2 plus 1 total is 3. Means the total is 3 in the sense the proportion of A is 2/3 and proportion of B is 1/3. Then comes have contributed 1 lakh and 60,000 respectively towards their capital. So this amount capital will be posted in partners capital as by balance brought down. How much was the balance of A? 1 lakh. Then 60,000. Partners account is a personal account and personal account shows credit balance. So we wrote by balance brought down. There is another opinion, since they told contributed, you can write by cash also. But generally we are assuming already the business is started previously. So they have the balance and we wrote by balance brought down. Then now we'll follow the rule. What they said, interest is allowed on capital at 8%. We have to calculate 8% interest on capital. So working number 2, interest on capital at 8% per annum. What is amount of A? 1 lakh into 8%, 8 by 100, 0, 0 cancelled. So 1000 into 8 is 8000. Whereas B's capital was 60,000 into 8%. 0, 0, 0 cancelled. 8 6 are 48. 4,800. This is the interest on capital which A and B are getting. So we are going to post to the profit and loss appropriation first. To interest on capital, partner A, partner B. A got 8,000 and B gets 4,800. One effect. Second, it will be credited to partner. So by interest on capital, A got 8,000, B gets 4,800. Then the next adjustment. A is allowed a salary of rupees 20,000. Only A is allowed. Salary is nothing but remuneration. So again, profit and loss appropriation to salary. We gave only to A, so we'll mention A 20,000. And this will be posted in partners by salary. And that is only given to partner A. So we wrote in partner A alone. Then during the year, A took 10,000 and B took 5,000 towards personal use. Means drawing. They are withdrawing the money. Drawings will be debited to partners capital. Only one effect of this. By drawings, A has withdrawn 10,000 and B has withdrawn 5,000. Then interest on drawings, they gave directly 1,500. So first we'll credit to profit and loss account. We'll leave one line gap and we'll write by interest on drawings. Again A, B. A got how much? 1,000 and B is charged with 500. Second effect, debit to interest on drawings. 1,000 for A, 500 for B. Then partners decided to transfer 8,000 to general reserve. So again, profit and loss appropriation. Only one effect now. Later we'll show in the balance sheet. So to general reserve. How much they told? 8,000. 8,000 we wrote. Then comes the focus point. How much was the profit? 45,000. So this 45,000 is brought from profit and loss account. So credit side of appropriation by net profit brought down. How much is brought down? 45,000. Like that, you are going to make first the postings. Once your postings are ready, you are going to do the workings for calculating the divisible profit and calculating the balance of partner. So, total again. So, first 8,000, 4,800, 20,000 and 8,000. 0, 0, 8, 8, 8, 16 plus 420. This was 40,800. So 40,800 debit total, 46,500 credit total. Credit is more, debit is less. So credit minus debit. Credit 46,500 minus debit 40,800. So 0, 0. Borrowed means 15, 7, 5. So this is called divisible profit. We have a divisible profit of 5,700. Now here is the most important part, how this profit is to be divided. I told you it should go in the ratio of 2:1. So first we'll find the quotient of this 5,700. Look on the blackboard here how the quotient is done. 5,700 divided by 3. 3 ones are 3. So 2. 7 carried. 3 nines are 27. 1, 2 zeros left. So the quotient is 1900. Okay. This 1900 will be multiplied by 2 and 1 to get the share of A and B. So here A share 1900 into 2 is 3,800, whereas B 1900 into 1 is once again 1,900. We got the share of A and B. This we are going to first post as profit and loss appropriation to divisible profit. A, B. A got 3,800 and B gets 1,900. One effect. Second, by profit and loss appropriation in partners capital, 3,800, 1,900. So profit and loss appropriation account is done. Now balance it, close it. Already we have the total 40,800, 40,800. Now comes the last account which is to be balanced. Partners capital A and B. So let us see for partner A. We'll write A. We'll write his credit figures. 1 lakh, then 8,000, 20,000, 3,800. 0, 0, 8. 8 plus 3, 11, 3, 1. So it comes 1,31,800 credit. Now we'll do debit of him. This was credit. Now I'll do debit of him. We have debit 10,000 and 1,000. Total we have 11,000. Total is 11,000. Now we'll find the new balance. So credit is more. Credit 1,31,800 minus debit 11,000. 0, 0, 8, 0, 2, 1. This is the balance carried down of A. New balance 1,20,800. Similarly, we'll do for B now. So B, credit 60,000, 4,800 and 1,900. 0, 0, 7, 6, 6. 66,700. Debit total 5,000 and 500. So 5,500. Again 66,700 minus 5,500. 0, 0, 7 minus 5, 2. 6 minus 5, 1 and 6. This is the balance carried down of B. This we are going to post it as new balance. So we'll come to debit side, new part, new capital, to balance carried down. A 1,20,800 and B is 61,200. Then close it. Don't close in the end. We are closing in the middle so that we can bring down the balance. A 1,31,800, both the sides, and B's 66,700, 66,700. Beginning of the year, his capital was 1 lakh. Now it is 1,20,800. Like that, here it was 60,000. It became 61,200. Capital is increased, that is fluctuated. So this we are going to bring as new capital by balance brought down 1,20,800, 61,200. Like this is the solution. Once again, first see how the postings are to be made, post it. Once the postings are made, do the proper working notes, calculation parts, and the distribution part. This is all about how to prepare the profit and loss, appropriation account, and partners capital account. In the next session, I am going to start with you all admission of a partner.